Anemic, that describes first quarter growth. And while many expected the economy to be weak, they didn't expect it to be this weak. Gross domestic product, the broadest measure of goods and services produced across the economy, grew at just 0.2%, a massive deceleration from the fourth quarter and much worse than expected. Federal Reserve policymakers also downgraded their assessment of the economy, leaving more questions about when the central bank will raise rates. We begin tonight with two reports. Hampton Pearson has more on the Federal Reserve statement, but we begin with Steve Liesman and the economy's slow start to the year.
The first quarter's weaker than expected GDP has ignited a debate on Wall Street and at the Federal Reserve over whether the economy is slowing more seriously or just working through some temporary setbacks. Severe winter weather in the east and port shutdowns in the west were the obvious temporary factors. But the negative effects of a stronger dollar and the decline in oil prices also played a role, and no one knows how long they will continue to hurt the economy. What we do know is that it was another weak first quarter in a string of them.
It's kind of a deja disaster. It's kind of like the same thing we saw last year. We came into the first release of GDP expecting growth of above 1%, and it came in effectively at 0. I do think that some of this is the normal volatility of the numbers, and we will get a bounce back.
Consumer spending hung in there with a nearly 2% gain after an even stronger rise in the fourth quarter. While economists believe lower oil prices and more jobs should prompt even higher consumer spending, it was not the main source of weakness. The biggest drag came from exports, which fell 7% and knocked a full percentage point off of growth. The strong dollar could be playing a role, making U.S. exports more expensive and hurting the overseas earnings of U.S. companies. Slowdowns in the ports and out west could also have played a role, keeping exports from leaving the country. Another major area of weakness, plunging investment in the oil and gas sector as a result of lower oil prices.
The minus 23 in structures is a big decline, and about, let's say about 15% of that will be related to CapEx in the energy sector. So the rig count drop in Q1 is certainly showing up there. We were tracking minus 11%, so that's about twice as large of a drop.
The good news, last year's sharp decline in the first quarter was followed by 5% growth in the second quarter. All Wall Street and economists can do now is wait and hope that GDP history repeats itself in 2015. For Nightly Business Report, I'm Steve Liesman.